All right, how's everyone doing? How are you guys? A very good morning from Montreal for all of you guys. Anyone new here today? Screen is pretty. Are you sing new? Okay. Warren Sinden, Nalinda Kumara, Hashan Chandima. Okay. So we got quite a few new people in here. How many of you guys were here on my last webinar? New to your live webinar, listen to recordings for a while. Okay. Michelle Gunther. All right, all right. Uh, so yeah, just actually we can start off. We had a nice we held a seminar in Toronto as well. That went quite nice with CMC and FX Street. There's Mr. Giuseppe. Um, And we had a full house, and it was quite nice just sharing some pictures with you guys. So it was quite a nice seminar that was going on, and that's me right there, and that's some charts. So yeah, that was a nice seminar we held at Toronto. Lots of fun, and of course, I'm a party person, so also got everyone drunk towards the end. So that was always a good time. So let's open up the charts. Okay, so the topic today is turning a negative account into a positive account using the same strategy. Now, this is some of the stuff I've touched base in Toronto as well on my seminars, and it's a very important topic because most people overlook it. They think if they have the right strategy, just the right strategy, things will change for them, you know? They start fantasizing about, like, if I just had the right golden goose, then things will change. You need to understand one thing in Forex. In Forex, the golden goose is you. Now, you have to train yourself to become the golden goose. That is the only difference. Now, you can use almost any strategy to use it. Okay? So that strategy, now, however you develop it, okay, to a certain extent, yes, there is the basics that need to be learned in the right way, which you guys see from my previous webinars that it's a whole different way, right? When you learn the traditional way versus the way that I've shown you guys. It's the same knowledge, but I'm showing it to you in a different light. So in terms of trading, give me a second. Let me get my mouse. 1 second. All right. So in terms of trading professionally, let me use this as empty. Okay. In terms of trading professionally, it's very, very important to understand one thing. Okay. The first and foremost thing is who is your opponent in any business? Okay? If you're in the real estate industry, what is your goal? Okay? It's to sell houses, yeah? Now, if you're trying to sell houses, who are you trying to sell houses to? You know, a customer. Can you see the customer? Can you understand who the customer is? Can you do your research on the customer? Can you judge him based on what he looks, what he's wearing, how he speaks, and how much is his bank account? You can judge all of that stuff and you can perform your speech accordingly to sell the house, right? In the Forex market, you never see your customer. Okay? This is the only industry where you're not putting your money to get a product in return or a service. You're putting your money in hopes to make more money. So you're betting on hope, which means your own hope. Okay? So your only opponent in the trading world is yourself. If you can control who you are, you pretty much have access to the industry. And that's why only a few can do this because it is really difficult to find fault in oneself, right? So it's uh, it's a very, very difficult process to go through. Now, let's touch base on some things here. All right, the next thing. Who are we? Okay, the opponent is yourself, but that's something you need to control into learning on what you need to do to turn profitable. Okay? Now, you're up against other traders, yeah, but you're not really challenging other traders. Now, for example, if one of you guys are sitting in the room and trading, you're not against the next guy trading in the same room. Your actual opponent is people who can actually move the market. We're talking about big institutions and stuff, so we're talking about the big boys. Now, these big boys, they don't move, hundreds of dollars. They move billions of dollars around. Okay? So we're talking about some of the smartest people on the planet. These are not people, some can even argue that they're smarter than rocket scientists, nuclear physicists. They're up in that level. These guys are smart, smart people. So you can't simply just come up with one strategy and then when something doesn't work, pop on to the next one. And if something doesn't work, pop on to the next thing. And if something doesn't work, increase your lot size. When it does work, you decrease your lot size or increase your lot size, or you double up, or you try to do revenge trading. All of this stuff, the little things that we do, needs to stop. Because the guy on the other side does not make mistakes. He will simply take the moment you make mistakes. Right? Do you guys agree with that? Or she. Okay. So you must be very, very consistent. Okay. And the next thing. One of the benefits that we have of trading is you're able to be opportunistic. Now, if you think Forex is a 24-hour market and, well, I work from, let's say, 9 to 7 and I'm free from like 8 to 12. So, Forex, the reason why I love Forex is 24 hours. I can trade whenever I want. Okay, it's not necessarily like that. If that was the case, what you're trying to do there is you're trying to force the market to fit into your schedule. You're pressuring it to do what you need to do. It's not going to happen. You have to adjust to what the market has to do and play accordingly, right? It's not going to set up, it's like the thing, right? The whole universe doesn't revolve around us, So we need to understand all this stuff. Benefits of trading. Okay. If you know your strategy and your strategy works in a very particular way, you have to wait for that moment. Don't just pressurize the market into making that moment happen, even though it's not there. Wait for it. Wait for the market to set up into that moment, otherwise you do not trade. And when that moment happens, some of the things that I do with a lot of my students is we take a GoPro or a camera or whatever you like, and we record the individual. We record the individual, let him take a look at himself when he's trading. Is he clicking his pen? Is his feet twitching? Is he getting too excited? Because the human emotion is the number one cause of problems in trading. Okay? So you have to watch all that stuff. If you can record yourself when you're trading, it's very important to study. What am I doing? What am I doing right? What am I doing wrong? Do I forget to think logic when the trade is setting up? Am I adding size? What happens when I lose? What's going through my emotions at that time? You need to self-reflect as much as possible. Without this self-reflection, you won't know where the problem is. All you're going to do is, this strategy doesn't work. There's nothing wrong with me. I need a new strategy. You see what I'm trying to tell you guys here? The problem is generally not the strategy, because if you go on to many websites like forums and stuff like that, the strategies are dime a dozen. They're back tested to I don't know how many years, and they're like, look at this, it's so perfect. Well, why doesn't it work then? It's the people who run it. Okay, so if we argue that, oh, maybe we should use EAs, well, EAs also don't work as well. It's not that simple as well. EAs would only work if there's a little bit of artificial intelligence in there, but without that, EAs cannot adapt as quick as your brain can adapt to certain information. Okay? So the benefits of trading is you can be opportunistic. You can wait for the right moment to come to you. Okay. This is one of my favorite things. It's a world of risk to reward. Now, many things in life, if you take a look at the big people, okay, if you study millionaires, billionaires, and all that stuff, you'll notice they don't mess around with 5%, 10%, 2%. That's not their game. Their thing is, if I'm putting in any amount of money, I want double, triple, quadruple, or more. Anything less than that, I don't touch. Okay? We're just trained to think as a normal individual that, oh, 10% a year, that's fantastic. The market must be excellent. Well, 10% a year is the return you get by putting up everything else you've got. That's some really high risk there. Okay, in the Forex world, it's not like that. Everything works to risk to reward. You can risk a certain degree of, like, for example, if you enter here, right there, okay, you enter somewhere there, your stop loss is up here, and you can keep your take profit somewhere there. You're looking at what looks like a 2:1. You're risking this much money to make this much money. Now, this type of opportunities doesn't get you you don't see these opportunities come by so quickly in many industries. In trading, yes. That's why it's so lucrative, but at the same time, it's also very dangerous if you cannot control it. Okay? Larger risk reward allows you to take more losses and still make profit. Yeah, absolutely, Leonard. So it's it's one of those things where if there is one thing you need to start making yourself as a rule is make sure all your trades have a minimum 2:1 risk reward. Bare minimum. Okay? Now don't go fooling yourself that, yeah, but if my win percentage is really high, then even if I take a half a R or half a I risk one to earn 50, or I risk $10 to make $5. but I win all the time. No, no, cut that crap out immediately. Don't do that. Okay, don't do that. You're wasting time and you're wasting highly important resources. The less you trade, the better you're gonna be. Okay? You know, people don't come out here and scalp day in and day out and be like, okay, now I make like 50 million this year. It doesn't work like that. They trade when the timing is right and they pull the trigger with large lot sizes. Now, how many of you guys, when you put a stop loss of 5 to 6 pips, get stopped out compared to 30 or 35 pips? Okay? Happens, right? So when you use a smaller stop loss, you're on the hunt. Okay, you're on the hunt by other players. You're on the hunt by brokers. Markets fluctuate also, so the little fluctuation will stop you out. So what is the need for a small stop loss like that? Well, greed usually. Okay, greed, trading too small of a time frame. You're looking to get into anything and everything. Okay, it's not necessary. It's not necessary. When you keep a wider stop loss and you're trading on a higher time frame, the chances of you getting snagged out is less. Now, if you just take a moment and think to yourself, if I was trading 3 or 4 more zeros on my account, would I be trading that same 5 to 6 pip stop loss? No, absolutely not. You'd be freaked out. You'd be extremely worried. 5 or 6 pips, and then bam, $2,000 gone. Bam, $2,000 gone again. You know, this stuff gets you really worried. So why train yourself like maybe I'll do this now until I reach $2,000 per trade? No, you know, train yourself the right way from the beginning. Okay? Hi Boyki. One guy here says risk two to get one. Oh, well, that's a that's a very dangerous slope, I would say. And in my experience, and from all the real traders that we work with and we've met, uh, nobody gets away with risking two to get one. It's very quickly that they're out of the game and they're back home. Okay? It's a tough industry. It's a tough industry, and you know, doing proper risk to reward keeps you alive to keep trading. Okay? He seems still alive. Well, look at all the traders out there. If you study all the traders out there, you'll notice it's a very rare thing that people do to have a small risk to reward. In fact, I in fact look at that as a negative risk to reward. Yeah, even with a high win rate, it's like basically saying I better be right. That's challenging the market. You know, that's saying I need to be right, market needs to follow me. That's difficult. That's very difficult. Okay? So now, all right. Here's another thing between a good trader and a bad trader. A bad trader is looking to make money as fast as possible, as much as possible. A good trader is all about controlling risk. Okay, it's all about controlling risk. It's all about knowing that, okay, I have this much money in my account. I need to do the best thing to protect it, which means no bullshit trading, no pulling the trigger whenever I'm uncertain, but I just get excited. And once I lose that trade, I don't go in with double the money. Okay? or when I win a trade, I don't think that, oh, now I got this. The market can never be, I can never be wrong in the market. And then you start going with larger lot sizes also. There's two sides to it. And there's also the fear side of it. The fear side of it, there's those individuals that they're afraid to pull the trigger, right? Like, I've been burned so many times, but the trade is my trade that's coming up, but I can't just pull the trigger. There's that also. Okay? So there's two sides of it. There's two sides. Okay? Initially, you have to trade a lot. Okay? Before you reach that stage where it's like you have to trade less to earn money. But in the beginning, unfortunately, you have to trade a lot to know yourself. The real key is knowing yourself. It is not knowing what the market does. It is knowing yourself. That is the real key. If you can self-reflect, you're on a good path. Okay? So the one thing I have all of my members do, if you take a look here. Okay. Now, here's one of the members which we've bought in and made him an employee. So notice this. Look at his first video. It says stock. Look at his second video. It says update. And then now his third video, post analysis. This last part, I would say, is the single most important aspect of the whole thing. When you do post analysis, it's basically saying, what did I do wrong? What was the mistake I made? Was it the strategy or was it me? Did I do something wrong? Did I get aggressive? Did I jump in quick? What did I do? It's these things that makes you a better trader. You need to self-reflect as much as possible. Now, another thing. I'm going to give you guys an analogy of Mr. Bruce Lee. Okay? I'm sure all of you guys have heard of Bruce Lee. And he basically says he's not afraid of a person who can fight all sorts of martial arts. He's afraid of a person who knows how to kick one particular way and has practiced that 1,000 times. So let me ask you guys this. When you go into trading, are you the best at what you do? Or do you try everything and anything that comes your way? Okay? You must find out one thing. Okay, you must find out one thing that you can do. If you're a support and resistance trader, practice just support resistance so well that you stand up and say, no one can do this better than me. Okay? First, you train one skill. We call that an edge. Okay? Call it an edge. What is your edge? Are you a range trader? Are you a trend trader? Are you a counter trend trader? Are you a supply and demand trader? Are you a support resistance trader? What kind of trader are you? And how many of those trades have you done? And how many of those trades have you tried to make yourself better with? Okay? Srinivasan, 240 to 300 per day. I am blown out. Okay, I can tell you right now, it's money management. Okay, money management and some sort of aggression. Now, when we're talking about 240 a day, yeah, is that pips or dollar amount? Okay, the only thing I can think of is if there is still a blowout happening, lot sizes are going larger, risk reward is reversed. To make 240 to 300 a day, your stop losses are probably just as big or bigger. Yeah, it's a dollar amount. Okay. So dollar amount actually, it needs to be more about pips. Okay, because the dollar amount can be very, very variable on your lot size. So And remember, if you're risk averse, you're not going to blow up. You can't. It's practically very, very difficult. Okay. All right. So shall we look at this trade right here? New Zealand US dollar. Okay. I wanted to make today's session as much as possible on what is right and what is wrong. And the answer to what is right and what is wrong is usually what are you doing? Okay, that's where the answer comes in. Because if you have a greedy mentality, what is right, what is wrong may differ from somebody else. Maybe somebody else is not greedy but is fearful. He's afraid to pull the trigger while you're trigger happy. So which is the correct one? Well, they're both wrong, right? But they both don't have the same problem. They have different problems. So most people will generally blame the strategy and be like, it's not for me, let's move on. Okay? Yeah, yeah. We touched base a lot on this on Toronto, and you'll be surprised of how many people are like, yeah, like it's it's a lot of it has to do with people. A lot of it has to do with people and not the strategy. The same strategy that you're using that initially got you interested. You have to use that because a strategy is only going to work if you like that strategy and you're like, oh, this is good. And then you do that strategy again and again and again until you get good at it. And then you fix all the little holes of psychology. That's how you master a particular strategy. Okay? Boyke, this is today's title. Okay? Jonathan, manage risk and know that you cannot win all the time. Fear reduces. Yeah. The thing is managing risk. You do your risk reward properly, you're already managing risk. You have a money management, you use a calculator. Here's a calculator that I like to use all the time. Let me show you guys. Okay? Very simple, very straightforward calculator. Pip amount, how much pips do you risk? Okay, let's say I'm doing a 32 pip stop loss, right? And I generally do this by fixed money instead of percentages. Now, how many of you guys have heard of the concept of you should risk 1%, 2% of your account, no more than that? Yeah? Now, let me explain the psychological side to that. There's a psychological side to that. If you have $1,000 account, how much is 1%? $10, right? To most of you guys, is making $10 or losing $10 gonna make a difference? No, right? But now, if you're trading a million, how much is 1%? Okay, 10K now. Now, trading at the amount of 10K can pretty much give you a little bit of a fear compared to the normal lifestyle, right? You might even go into 0.5% of risk. Okay, so it's very psychological. If the amount is too small, you're not gonna give a crap. You're not gonna give a crap. So when you do a fixed money amount, for example, if you're a person who goes out, I've taught this in a lot of my previous webinars. If you're a person who goes out and he likes to spend, let's say, $50 a day, that's your tolerance. Don't go into the market trading $300 per day. You can't stomach that because once you say I can do it, it's fine. You lose 300 once, you lose 300 twice. Now you're on tilt. You can't focus on your strategy properly because your mental state is not correct anymore. You're like, oh my God, I lost $600. That's a lot of money.
That's my rent. That's this. That's that. Like people start freaking out. That's what we call on tilt. You go on tilt, right? You can't focus properly anymore because now you're relating real world scenarios to the amount that you've lost or won. Okay? So you have to keep that in perspective of how much can I stomach on a day-to-day basis. Okay? That amount needs to be something that if you lose it 2 or 3 times in a row, it's okay. It's okay. So whatever the amount of money that may be, let's say you're okay with $30 per day. Okay? Or $30 per trade, which means you can be doing like $100 per day spending, and you're on the market. You're like, okay, $30 per trade. I can lose 3 trades in a row, and that's okay. It won't affect me mentally. Then you choose your currency, and you're doing 32 pips of stop loss, right? Now, if I calculate it, it's going to tell me my unit size or my lot size. I don't change this number of $30. I keep that the same. Whatever your number is, you keep it the same. If your risk changes, now suddenly if you're trading a big trade and you have a 70 pip stop loss, you calculate that. Your lot size reduces, but if you lose that trade and you lose all 70 pips, you still only lose $30. You must keep this sequence constant. This is how you track your performance, and this is how you know what am I doing wrong. Because this number is the number that you're mentally okay with. Okay? So it also starts from here. You don't want to go on tilt. You want to be smart about your trades. You start with here. You do proper money management. You don't take a trade without using a calculator. Okay? Marco, how much should we risk per month, per week, per day? It's personal preference on that. It all depends on what kind of trader you are. If you're aggressive, what is your lifestyle normally outside of trading? Because whoever you are is going to reflect on the market. The market will show you immediately. If you're a scared person, the market is going to show you. If you're greedy, the market is going to show you. If you're conservative, market's going to show you. It will immediately reflect who you are. Okay? So you got to be good with managing your money at least to this level. You do this part, you do money management correctly, and then the next thing is all about focusing on self-reflection because you are the biggest opponent of trading. Yeah? All right. Give me some questions that are coming to your mind. Tell me some things, before coming to this webinar, when you read the description or the title, like what comes to your mind? Like, what am I going to learn here? What's coming to your mind? Okay. Jonathan, consider marginal utility of money. Yeah, yeah. Boyke, which time frames are safe to trade? Um, I would say initially, if you're starting off, 4 hours or above is safer because it gives you less things to track. If you're trading a smaller time frame, not only do you need to track technical stuff, you need to track fundamentals, and you need to be aware of the broker trying to come after you. These 3 things, that's too much to keep track of. Initially trade a higher time frame, which means you can be purely on technicals, and if the fundamental news kicks in, it's probably going to be within the same candle anyways. So it gets filtered. Okay. Vic, what approach methodologies can we use every morning when market session starts? So much information to take in account. Yeah. This is actually a very good question. It's also I have a webinar at FX Street that was recorded on this. It's called the trader's routine. What do you do when you wake up in the morning and you sit down as a session opens? What do you do? Do you have a process that you're using? If you have a process, you need to write that process down. What do I do first? What do I do next? What do I do next? Now, here's the most important thing that everyone forgets. that everyone forgets is the moment they pull the trigger, all logic goes out the window. This happens with 90% of the new coming students to me. They do everything so perfectly up until the beginning and until they take the trade, but once the trade is on, they forget all logic. It's all emotions now. Okay? That you need to have a process for also. Once you're in the trade and the trade is making profit, what do you do? Once you're in the trade and the trade is going slightly against you, what do you do? Once you're in the trade and the trade is 6 hours into it or 3 or 4 candles into it and you're around break even, what do you do? All these things, once the trade is active, people don't know what to do because emotions take control at that moment. Because the trade is on, people get excited. They're like, oh, I think it's going to go more. They move their take profits. Or if they're fearful, they're like, I think that's enough profit. I don't know if it's going to go anymore. Let me take something. Something is better than nothing. They close the trade early. Okay? Or if it starts going against them, man, I don't know, man. I don't know. Let me move my stop loss. It's too tight. All these things, this also requires a specific procedure that needs to be written down of what you're going to do when things go your way or go against your way once you activate that trade. Okay? So all the stuff needs to happen ahead of time. You need to analyze everything ahead of time. Okay? Nothing happens very, very quick on the whim. Okay? Wait, let me get to these questions. Let me open this up a little bit more. Okay. Yeah, so thank you for the link, FX Street. Reflect on market when it's end of day before really, then have an idea for. Yeah, I don't know if I'm not gonna turn on my webcam right now, but I can show you the board basically behind me. It's full of what am I gonna do tomorrow kind of thing. It's all preparation. You think the billionaires go out there and be like, okay, I have $1 billion that I need to trade, and I'm just gonna open a trade. And then I'm just gonna wing it? Are you kidding me? They're not gonna wing it. Everything has a plan, a procedure, a process. Okay, there is no winging it. Okay, Ayush, how do you know if the broker is coming after you? If you have a larger lot size and your stops are small, they'll come after you because you're providing liquidity to their liquid pool basically. Okay, because one of your trades is gonna feed 7 or 6 other traders in their liquid pool, so they're gonna come after you. Okay. What are the significant time frames of the day to trade the pairs? Well, it depends. If you're trading the smaller time frame, then it doesn't matter based on what happened yesterday. If you're trading, for example, 30 minutes or 1 hour, what happened yesterday doesn't make so much of a difference because you're trading sessions now. You're trading London to New York to Asian. But if you're trading the 4 hours and daily, then it matters what happened yesterday. It doesn't matter based on sessions anymore. It's mixed. If you're trading the higher time frame than that, then all sessions go out the window. You don't care about sessions. All you care about is what happened this whole week and so on and so forth. Okay? So the lower time frame you go, there's more things to keep track of. Remember that. And that can be mind-boggling. All right. Ayush, how do you know if the broker is coming after you? Well, I think we just discussed that. Boyki, can a robot be programmed to do all you said today? Yes, I'm sure it can be. I'm sure it can be, but it's one of those things I would say if you can program it yourself, it's much better. If you can do it yourself, it's so much better. Because the thing is that when the markets are good, right? You have a feeling when the markets are good. Now, when the markets are good, I also go in with larger lot size because I understand what is a good condition after trading for all these years. And I go in with larger lot sizes and I milk the thing. So there is one aspect of being scared on each trade, but then when your thing comes up and you know that, oh, this is a better one than most of the time, you also have to milk it. That's the name of the game. When the opportunity arises, you got to milk it also, but you have to know that opportunity is going to work. Okay? Uh, Akbar Ali, Naveen, please share some of your support resistance techniques. Yeah, we had support resistance the last two webinars, so we're not going to touch base on that today. Plus, we're almost out of time. Um, you can watch the recordings for that. Vic, regarding your webinar on predicting the Forex markets hourly, can you give us your opinion on, well, we're not going into analysis, Vic, today, unfortunately, but I'll be happy to do it on the next session. Leonard, Naveen, problems with robot is they are automatic and don't have the feel of a good trader. I I sort of to a certain point agree with that, but I've seen some stuff lately that's quite astonishing because they're starting to put in artificial intelligence into robots now, which is they're starting to calculate and adjust accordingly. That's quite incredible. And I think if that's the case, then they can match human behavior. But I'm talking about not an EA. An EA is pure logic. I'm talking about artificial intelligence, which understands, adapts, adjusts, reprograms. Okay? And EA to me will always be not good. I don't like EAs. I'm sorry. All right, guys. So we're almost out of time here, but I want to close off by saying one thing. Just remember, if there is one thing you can take away from this webinar, you know, is self-reflect. Self-reflect. After each trade, stop. Before you don't get on to the next trade, you just stop. And you take a notebook and you journal. What happened? Did that trade work? Did it not work? What did I do right? What did I do wrong? Really self-reflect. Put more focus, not on the strategy, but on the emotion. How was I feeling when the trade activated? How did I feel when I was getting a little bit negative? All this is very, very critical. This will help you to become a better trader, not changing strategies. So stick to your strategy, stick to your values, and make sure you keep a good money management risk reward. And that's going to take your same negative account and the same strategy into a positive one. All right, guys, that's it for today. Thank you all for coming. Next week, we'll go, next month, we'll go more into live analysis and stuff for you guys if you want. All right. Thanks a lot, guys. Take care. Have a good one. Thank you, FX Street, for having me over.